Good morning, everyone. Welcome to our webinar. We are so excited that you're all here, and we have a really interesting webinar today. There's been a lot of talk about ASC 606 and the new revenue recognition standards and, what we should be doing in order to be compliant. This webinar is more about what happens if we don't comply? What happens if we decide to just blow off this new revenue recognition standard or think it doesn't apply to us? So we're going to talk today about the opportunities that are inherent within the new revenue recognition standard. We're also going to be talking about the penalties and really going to get a good sense for the consequences and also potential revenue gains that you can get to your business by complying with this new revenue recognition standard. So thank you so much for joining us today. We have truly an all-star team with us to talk about this, true experts in the industry. We have Basil Cheedy-Funk, who is a financial consultant for Simplus. We have Randy West, who is Simplus's Director of CPQ and Quote to Cash. Tim Smith, a Senior Account Executive and also a financial services expert. And our very own Michael Scott, who is going to grace us with his presence. So welcome, guys. We're so excited that you're here today. Thank you so much for joining us.
Thank you.
I would like to, yes, we're thrilled. We also want to kind of give you, our listeners, a little bit of a background of each one of you guys. So Tim, let's start with Tim. Tim, you are a senior account executive with nearly 30 years of sales and financial services experience. Is that correct?
That's correct. Yeah.
That's correct. And what's really great about Tim as well is he served as an SVP, EVP, COO, and president in a number of companies. Tim knows about revenue recognition. He's lived it. He's had to do it in his own company. And he also focuses on user adoption and utilization metrics and knows that a fantastic solution is only valuable when it's truly used. So I think that focus on really enhancing the solutions that we have and fully utilizing our offerings is really important and very helpful to our attendees. Basil Cheedy-Funk, thank you for joining us. Basil is a financial consultant who helps us with technical accounting advice and complex accounting issues. So he has started his career in public accounting at Ernst & Young in San Francisco. Then he got transferred to the New York office to join Ernst & Young's national team. He got recruited by PwC to join their transaction services team in specializing in accounting change and complex accounting. Then was recruited by his private equity client to help with accounting policy, mergers and acquisitions, special projects, joined Lending Club Corporation later, and was the head of accounting policy and oversaw his own implementation of ASC 606. So Basil has worked as an accountant, as an investment banker, and as an implementer of ASC 606 himself. So Basil really knows the ins and outs of all of this. Finally, Randy is our Director of Quote to Cash at Simplus. Randy brings over 17 years of CPQ experience to the management of the Simplus Quote to Cash practice. So Randy was the former CPQ practice manager for Deloitte, and he is just absolutely premier talent for managing CPQ resources, project delivery, customer satisfaction. He was also formerly a senior director at Big Machines. So as you guys can see, like when it comes to ASC 606, when it comes to accounting and the financial services vertical, we truly have the best in the business right here on this webinar. So without further ado, I'd like to turn the time over to Basil. And Basil's going to talk generally speaking about what ASC 606 is, why we need it, what the consequences are, and I'm really interested in learning more. Basil, take it away.
Thank you very much, Amy. So now I will give an overview of the 606 standard. So ASC 606 is the new revenue recognition standard known formally as revenue from contracts with customers. and known informally as the standard of the century. This is the standard the converged standard issued by both the FASB and the ISB. The standard was issued primarily to improve comparability of revenue recognition practices across entities, industries, jurisdictions, and capital markets. It was issued simply to just simplify revenue. Under the pre-existing revenue recognition, there were too many guidance companies had to consult to determine the appropriate accounting for revenue. If you attempt to count all of them, starting with the legacy GAAP, industry-specific guidance, the SEC staff accounting bulletins, conceptual statements, and other non-authoritative guides, you'll be looking at over 200 different accounting guidance. With the emergence of new technologies such as new industries such as fintech, which is finance and technology, both entities and regulators have had a tough time identifying the appropriate guidance to consult. So this guidance is just really intended to simplify the process and issue for everyone. The initial 606 standard was issued in 2014, and since then there have been almost 10 amendments to clarify the standard so it's easy for people to adopt. The current modified standard is less converged than what it was back then when it was issued in 2014. The current standard is expected to have monumental changes on how companies account for revenue, develop and execute contracts, processes and controls, financial reporting, as well as overall systems that will be used to achieve these changes. This session today is even more important because regulators have indicated that they will be looking out for companies that have not properly implemented the standard. There are many issues and problems that were being encountered due to having too many accounting guidance, and they include lack of consistency when determining performance obligations, errors due to use of inappropriate guidance, and difficulty automating processes and controls. Next slide. So there are three things to really know about the standard. What is it? Who does it apply to? And why do we need it? So the new standard, as we mentioned earlier, is it's the FASB and the ISB. They largely converge revenue, so it's easy and it's universal across the world. Who does it apply to? It applies to all industries and entities that execute contracts with their customers so they can provide goods or services and certain non-financial assets like property and equipment. Why is it important? It's important because it just simplifies the revenue recognition process and clarifies obligations between businesses and customers. Next slide. So, next slide, please. So what changes do you have to make here? So the changes you have to make here are, first, you need to first make changes to your systems. And for the systems, what is really important to know is that in my experience here, finance teams, tech teams, consultants usually have to do a top-down assessment of the existing systems and develop a gap analysis, which leads to a business requirement document to identify technology needs. This is a very, very time-consuming process. So you essentially have to understand what are the needs of your systems to be able to implement the standard. Next is your contracting process. So your contracting process might need to change. For example, some companies are changing wording in their contracts to maintain business models that they have originally set, as well as to avoid having to defer revenue. For instance, under 606, a provider has to assess and estimate the revenue that will be paid by the customer, even if the contract price is, say, for example, $1,000, but you know your customer can only pay $800 at the time you're executing your contract. The maximum revenue you can really recognize is $800. So companies need to actually really revamp their contracting process to make sure that the customer can also perform under the contract. Due to the new revenue policy, tracking of data and financial reporting requirements, new controls and processes also need to be implemented. Then, cost to enter and fulfill contracts like sales commissions also need to be tracked at the contract level. This is a very important point to note because now under the new revenue recognition standard, you can actually defer certain expenses that are incurred to obtain contracts, expenses such as sales commissions or commissions paid to sales staff. You can actually amortize that and expenses over the life of the contract. And lastly, the financial statement preparation. More disclosures are now required under the new standard. Next slide, please. So there's several things to really understand about this slide here. So this standard is already effective for publicly traded companies. This standard was effective for fiscal year starting after December 15, 2017. So for most public companies that operate under the calendar year end, January 1st was their January 1st, 2018 was their effective date. But for private companies, it's fiscal year starting December 15, 2018. Implementation projects like this usually can take up to 18 months to fully implement. However, the deadline is in 10 months. So if you haven't started this process, then you are at risk. Next slide, please. This is the worst. So please, if you haven't started, start considering doing this as soon as possible. So the transition process. The transition process usually involves recognizing revenue under the current legacy GAAP up until the transition date. Then you set up revenue contract with multiple element arrangements. Then you start to recognize revenue as you satisfy performance obligations. And then you record an adjustment on the effective date. So the FASB does give two methods of doing this transition. They have the full retrospective method as well as the modified. The full retrospective method involves you restating all prior periods, whereas the modified requires you to only look at contracts that are still effective, so contracts that have not been fully satisfied before the effective date. Next slide, please. So here, this slide. This slide here focuses shows the timeline for the 606 on IFRS 15. So what's really important to note here is that there is a distinction between public business entities and non-public business entities. So for the effective date, you can see that IFRS 15 has the same effective date for public companies and non-public companies. However, for US GAAP, it does separate. It has the effective date for public companies for fiscal years starting after December 15th, then for non-public companies starting December 15, 2018. So this is really very consistent with the FASB's rule of giving private companies a 1-year deferral or lag to implement new and complicated standards, because the FASB does recognize that private companies usually do not have the level of resources that public companies have. So it's giving them some time to get up to speed and implement the standard. However, again, I would like to point out that it takes a lot of time and effort to implement a new standard. So for private companies that have not started, you are running out of time very quickly. To implement the standard, you will have to review your contracting process, assess the compatibility of your systems, design new processes and controls, perform a test of design and effectiveness, implement, and test again. Next slide, please. So on this slide here, the 606 introduces a 5-step model for recognizing revenue. So the first step is identifying a contract. So this is where your contracting and contracting process described earlier comes into play. So here you have to evaluate, has the contract been executed? Can the counterparties under the contract perform and satisfy their obligations? Then the next step here, you would have to identify all the promises you are making to the customer in the contract. So under legacy GAAP, you could actually provide customers free goods and services and you recognize zero revenue for them. But under the new 606 guide, any freebies you are giving to the customer, you still have to recognize revenue on some portions of it, because it is a performance obligation or promise you are making to the customer. Next slide, please. So the next slide here, we're going to focus on slide 3 and 4. So for slide 3, you have to determine the full contract price. So after determining full contract price, then you would have to identify the standalone price for each of the performance obligations or promises you have made in step 2. So after you've identified all of the standalone prices for the promises you've made in step 2, then in step 4, you now have to go do an allocation. And what you find is most times companies have to do a relative fair value allocation. Because before, under legacy, there were certain items, there were certain promises made that zero revenue was recognized, but because of the new standard, you have to allocate something to it. So companies do have to do a relative fair value allocation for here. Then on step 5, what comes to here is when you start to recognize revenue as you are performing and satisfying your performance obligations. So as you start doing the allocation in step 4, in step 5, as you start to meet these performance obligations and deliver on those promises, you start to recognize revenue that has been allocated to those promises. Next slide, please. So what are the consequences of noncompliance? Here we have summarized 5 key areas. So 1, companies not ready will need extensions. Examples include private companies that either report into public companies or private companies that report into private equity or private companies that have some reporting requirements. It may be from a debt covenant issue or just be from a regulation standpoint. Here you would have to file an extension or ask for an extension, which is not good. Next, the second point, for companies seeking funding or trying to position themselves for an acquisition. And these are areas where companies always get asked, how ready are you for implementation of new regulation and standards? If you're not ready, you could suffer some impact to your valuation. Third, negative publicity. Negative publicity from non-compliance could lead to brand impairment. And this brand impairment would also result in an impairment to your valuation. Fourth is lawsuits. Lawsuits always come whenever non-compliance with regulations come into play. Here you start to see lawsuits from maybe investors who think you haven't fulfilled your fiduciary duties, or you even start to see lawsuits from customers or clients. And last are fines. Here you get fines from accounting regulators for non-compliance, and sometimes it does lead to prison sentences for some members of the executive team. Next slide. So which industries are affected? Every industry is affected in 606, going from aerospace all the way to timeshare, software, healthcare, hospitality. However, some contracts are exempted from the new standard. Such contracts include insurance contracts, derivative contracts, leasing contracts, as well as some financial guarantee contracts. Thank you.
Well, Basil, thank you so much. That really drives it home that, especially with, those 5 different penalties for noncompliance, they're not messing around. I guess we don't mess around with the government when it comes to revenue, right? So
No, we don't.
thank you very much. That's right. Thank you very much, and that was very informative. Next, Tim, we'd like to turn the time over to you to talk about how we can use those 10 months that we have left to our advantage to implement ASC 606 as quickly and as easily as possible.
Great, thank you, Amy, and thanks, Basil. Fantastic information, and I believe everybody is sufficiently scared now, so that's good. Now you set me up for a win here. It is a scary situation, or it can be a scary situation, if you're not ahead of it, if you're not on top of it, if you're not even sure of your current processes and procedures. It can be a tough situation to move to this new rule, and we could hide, but let's think about it. We have a couple of ways that we could make this happen. We could continue to use spreadsheets and notes and folders and bodies to track everything, to constantly go back and re-recognize rev, just make changes along the way, do a very, very manual process. Based on everything I've seen, that's going to be a little tough to keep going, but you could do it that way. You also could use another system that maybe isn't part of the Salesforce world, and that's okay too. The only challenge with that generally is there's not one system that does all of it. So you have integrations to deal with, you have data integrity concerns when you have more than one system, a lot of different challenges around that. So we have a recommendation and a solution we believe can actually make this happen easier for everybody. One platform. We all know technology today can be used for awesome things, but let's think about how we do that and what's the most efficient way to do so. So we believe that using Salesforce, which a lot of you may already be using in some capacity, but using Salesforce along with Salesforce CPQ and then a system like Financial Force, you have one end-to-end system. You have all the points along the way that you need in order to stay compliant. For example, at the front end, we talked about this really kind of brings the process up quicker, where we have to be thinking about RevRec and the effect on that while we're even in the selling process. Now, I'm not going to sit and train my salespeople how to recognize revenue, but if I have a system in place that enables them to keep us compliant, then a couple of things happen. They can be speaking logically, effectively, with knowledge. Not only that, they can be kept from promising something that we don't want to have happen, right? If I have a system in place, I can guide them to what I believe is the best solution for our revenue recognition. Doesn't mean I'm going to take over the sales process, but I'm going to keep them enabled to be the best possible and keep us on the right track for what we want as a company. Feeding that then into the quote to cash lifecycle, the whole Salesforce CPQ, it means I can really guide that. I can say, look, you're not going to be able to do a 50% deposit because that messes up this piece. You're not going to be able to commit to one person that it's a 50% deposit with payments 30 days along the way. Another person it's 25%, and then they only have to pay when there's a milestone hit or product delivered or the second piece delivered or a service system. We can put regulations and systems in place for our people, our team. We can empower them to have that conversation and really move along the cycle. Just keep it smooth for our users, right? Keep it smooth. Keep it smooth for our customers so that they don't know of anything going on. They get documents, they get quotes, they get contracts, whatever it might be, saying, here's what I agreed to. Here's what I committed to. There's no coming back later and saying, we know we said this, but now we have to change it. And then the best part is that now all that information, everything we've committed to, those performance obligations are now in a system that we're going to feed into our revenue management tool. We believe Financial Force is the ideal solution to make that happen. And it's 100% on the platform. So everything I've done along the way, that data now feeds my performance obligations. My performance obligation feeds when I can recognize the revenue. Yes, it feeds, my Glapper, and I can do invoices and accounting and all that good stuff. But it also means I stay compliant to this rule. That's, to me, one step from end to end. And let's take a look at the cycle. So next, please. So we've got a bunch of different processes in this RevRec cycle. Generally, it's going to start with my personalized presentation, my proposals. Like I said, I don't want my sales team to have to put out a proposal that we can't meet. They have to go back and eat crow in front of it's just not good. Let's give them the power they need, the information they need to make the right proposal along the way. Configure, price, and quote. Same thing. Let's make sure that a system empowers them to keep that on track. The system knows what we can do, what we can't do. We as operations on the backside can make those changes as needed to keep us compliant. And it just keeps our overall system and our overall process compliant. Negotiate and manage contracts. There's some great tools on the Salesforce platform. CPQ itself is a great one, depending on how complicated your contract piece is. Maybe we need to use a contract lifecycle management tool. Again, on the platform, keep all that data in one nice spot, and boom, that feeds into billing and recognizing revenue and managing renewals. And then, and this is something we don't talk a lot about, but we should, uncover actionable data. By having everything in one platform, I can see, is this new process restricting sales? Is this new process is it too cumbersome, or clients leaving us because of this? Is it keeping us compliant? Is there a change that's happened? Because we all know once rules come out, sometimes changes or updates or tweaks or whatever they want to call them are going to happen. How do we make that happen easily based on the data that we have? Well, if I have it all in one system versus 17 Excel sheets, then actually I make better decisions about that data. Next, please. And the big question. So can I become compliant without spending a lot of money? Well, keep in mind that it's going to take money to become compliant. It just is. You're either going to spend time with Excel sheets and hiring additional bodies, bringing in consultants, hiring a firm to outsource it, whatever it might be. You're going to spend time and money, even if it's just internal money, to make this happen. That's true whether you go with Salesforce or not either. But there's a couple of factors, and these factors affect across the board. If I have two products, and Henry Ford said, right, they can have it in any color as long as it's black. If that's the case, my implementation is going to be relatively quick and easy. But if I have additional products, or what I've seen is I have a lot of products and those products have variables, right? Then it could get very complicated. It could take not just cost, but more time. So we need to really be moving on this if we have a 10-month time frame. Contracts, again, standard contract, it is what it is, you're fine. Various contracts for various people, various situations, it's going to take a little more time and therefore more cost. Is it a department level change or is it org-wide change? In other words, do I just need to tweak a few pieces right here, or am I doing a whole overall company structure, corporate structure really, change in order to fit this new rule? Few changes or more changes, that's an obvious one. And then time. If I have plenty of time, I can make things happen. I can make them happen in the right spot. I can make them happen and I can spread out either cost, and I'm not stressing and straining, and that adds to the cost. If, however, we wait until October and decide we need this done by December 15th, we may have a problem. Now, we all know projects can happen with unlimited time and money. Any project can happen, but let's kind of avoid that. We'd rather start early and do the right things, make the right choices, and watch that cost along the way. Next, please. What we have found, because it's not all doom and gloom, I promise. What we have found is compliance can actually lower your cost. Yes, it's going to be a headache to get there. Yes, you're going to have to make some changes, probably in people, processes, and systems. But from there forward, you can actually lower your cost. Right now, you have a problem, you have a project, you're delivering a service, or you're delivering a good. Let's go with delivering a good, and you're going to offer ongoing support. But halfway along the way, instead of 8-hour SLA, they want a 4-hour SLA. Now you're changing the contract. Now I got to go back to an Excel sheet and figure out what the revenue piece of that is and how to do that. Why don't I let a system calculate that for me? Mid-cycle changes are so much easier if I have it on one system like Salesforce and Financial Force. You can speed up that sales process with an automated process. Your salespeople aren't having to come to accounting every time to see if they can get approval or legal. It's all right there in the system. Not only that, it makes that user experience so much better, that customer experience. I've had folks tell me, salesperson says the deal is closed won. 3 weeks later, we're still working on financial obligations and contracts. Well, why? Let's automate it. Let's make that happy. Customer might go ahead and do this one, but are they going to buy from us again if it's that much headache every time? And then, like I said before, you'll have more visibility. You get to see the data. You get to know what's happening in your system. You get to see if there's issues coming along the way because you have all the data in one spot. Next, please. So I'm going to hit the 5 key takeaways. I believe this is my slide. I'm going to go ahead and proceed. There's 5 key things to take away from today. You're going to need to change your process, your quote to cash. How you get them in the door, how you sell it, how you deliver it, and then how you recognize that revenue. It's going to need to change just to meet the new standard. It just is. That's a fact of life. The rest of it is options. The penalties are potentially severe. Lawsuits and all that, yes, fines. They're going to make an example of somebody and somebody's going to go to prison if they don't follow. It's going to happen. That's the way life works. All industries are affected. I've had so many clients over the last year or so. Well, what about me? It doesn't really affect me. I don't do subscription-based. I don't do this. I don't do that. You know what? That's fantastic. But it does affect everybody. If you sell something to somebody and you have an obligation and they're paying you for that obligation, it's going to affect you. But the good news is there's a solution out there already that companies like us or others can help you implement, where I can use my Salesforce, I can use CPQ, maybe a contract management piece, Financial Force. I can use technology to keep me compliant and make this process a whole lot easier. And then we see that by doing so, going forward, it will actually save me money. I'll be more efficient. I'll have to throw less bodies at the challenge. My audits will be easier, so much, and so on. So 5 key takeaways. So the good news is, next, Next. Yeah. You're going to be just fine. Now, as we all know, Michael says certain things and he means others. Okay. You are going to be just fine if we take action now. We've got to get started on it. You've got to make that move. You've got to get the help you need or do it yourself, however you're going to do it, to be ready for this, because we certainly don't want the government coming to you afterwards. That's actually the presentation. What we'd like to do is, Amy, I'll hand that back over to you.
Well, thank you, Tim. That was very well done. I feel, even though, I feel like running over to our accounting department and making them watch this webinar right now, just to make sure, because I think you guys articulated it very, very well. We have some questions from people, our attendees, and I wanted to open up the time for questions. And there are enough of us that if you guys have some in-depth questions, we would love to have you chat them in your webinar control panel. You could also email us later, either at success@simplus.com or reach directly out to Tim at tim.smith@simplus.com. We want to help you make sure that you're compliant, make sure that you've got everything prepared in advance. But if you wouldn't mind, I'd love to also open up this panel discussion to Randy West as well. Randy, thank you for being on to help us answer some of these more technical questions that people may have about Salesforce CPQ. Our first question is for Basil. One of our attendees asked, and I'm not totally sure whether we have all the information to answer this, but the question is, I use a % of completion now for over 300 open contracts to recognize revenue. Can I continue to do so? Basil, can you answer that question for us?
So the percentage of completion method may not have a significant difference under the 606, but you would have to prove it out. So what's happening here with 606 is that you're not looking at performance obligations, but some companies may not actually have any change from the pattern and timing of recognition. However, they still need to do it. They still need to prove that out. So what you would have to do is look under your current percentage of completion method, look at pick a sample of contracts, look at what the revenue that has been recognized under those contracts using the performance of completion method. Then you now look at 606 and look at how the revenue would have changed. So the good news is that in some circumstances, you may not have a change in revenue, but the FASB and the SEC want everyone to prove that out. So that means you still have to look under the legacy method and under the new method and see what your delta is. And that's how you'll be able to answer that question, if you can still continue your current method or if you would have to make a change to your accounting recognition policy.
Okay, thank you. If that person would like to, ask another question, if you have any follow-ups, I can ask that as well. Thanks, Basil. Let's go to the next question. Can you tell us just a little bit more, Tim, about what platforms we can use to help us automate this process? I know that we mentioned Salesforce and Financial Force. Is that the easiest and the best? Are there other platforms? Kind of give us an overview of pros and cons.
Certainly, that's an excellent question, and it's something that we have a special team here that actually can start the conversation that way. We are somewhat agnostic. We tend to lean towards Salesforce and Financial Force because we know them, we use it ourselves, and we are platinum partners for those solutions. But we always like to start the conversation with, what do you really need? What is your situation? And is it the right fit? And if it's not the right fit, then we're not going to proceed forward, but at least then you'll know. So are there other options? Yes, there's other options for sure. But we found that on the the use stories that we've seen, the need that this rule is enforcing for compliance, that having it as one platform, and that's the key, having it as one platform, all speaking to each other, will save you time, energy, and headache. Every other system I've seen involves some type of integration outside that system, and that's where your challenges could lie.
Okay. That's excellent answer. Thank you very much. This next question is for Randy. Randy, thank you so much for joining us and helping us on the technical side of this. One question that we have is just from a systems perspective, in the whole quote to cash process, what element of that quote to cash process will be most impacted with these new revenue recognition standards?
The questions that clients are asking me now, whether some of them have existing CPQ and quote to cash systems, and some of them are implementing new ones. The first is around deal approval, because we spent a lot of time in the past really allowing for VSOE, or really the approval of what I call revenue impairing deals. So we need to take a look at how those approval processes are mapped out and make sure they help you out relative to the new regulations around revenue allocation and multi-member arrangements. And then the other thing we need to think about is the quote to order conversion process. And the reason this comes up is that map between a quote line and a revenue line is changing. So that the way quote lines lead to performance obligations now is not going to be the same tomorrow. So those are the two areas where I get most of my questions, and we spend most of our ASC 606 specific time.
Okay, excellent. So if there's someone here on the webinar, Randy, who has some specific technical questions, let's say they're Salesforce users or even Salesforce CPQ users already, and they have particular questions, what's the best way to contact you to ask some of these particulars?
Well, I don't see my direct email address on the slides, but I'm sure if they send it to success@Simplus, that you'll kind of play quarterback and make sure I get the questions I need to, won't you?
Absolutely. I'd love to do that. Sounds great. So if you guys have any questions for Randy, send it on to success@simplus.com. I'll make sure you get in touch with Randy and you have all of the questions answered. Randy is a true expert in CPQ, and he can answer basic process questions all the way to the most technical CPQ questions. Randy, I actually have another question for you. So the question is, why do I need to pay more attention to my quote and contract documents tomorrow than I do today?
It really goes back to my answer to that first question around quote to order conversion. It's because the map between a quote line and a performance obligation or a revenue line is going to change. So the changes that you may allow field salespeople to make today that don't really have any impact on your revenue recognition processes could end up causing you problems tomorrow. So you want to pay attention to the way, not only the way those documents are generated, but the way you allow the folks in the field to modify them, just so they don't drive any unintended complexities when you go to close the books.
Okay. Excellent. Thank you. We just have time for one more question, and I think that this question, I'm trying to decide between a few. I think the one that I want to talk about is with Tim. How bad could this be to keep doing manually? That's the question, is like, let's say we've got it on Excel. It's a fairly simple process. How, as we grow, as our companies grow, how bad is it going to be, and what's the right time to move over to more of an automated system?
No, that's an excellent question. And it is the first question you think about. If I'm selling a product, I don't give discounts. They can't earn points for future discounts. If it's a pretty straightforward business that I have, I can probably keep track of that on an Excel sheet. But if I have any type of variation, if I decide that I'm going to treat, let's say I'm in retail, I make shirts for a living, and I'm going through a distributor, and I'm going to treat one distributor one way, another distributor another way, I'm going to have to start putting rules and processes in place. And that's going to be hard to do on a flat piece of paper or screen like Excel. And so it really depends on that variance. And it depends on, do I want to grow? And also, at some point, it depends, do I want to risk not being able to do an audit easy, not being able to get answers when I need them, and not have the data I want in order to move my business to the next level? So can it be done manually? Yes, of course. But the ability to handle variances and for growth, you're going to need to pick a system and make it happen there.
Okay, thank you so much, Tim. I appreciate that. All right, well, everyone, to all of our attendees and to all of our experts, thank you so much for joining us. I found this to be very enlightening. Every time I study ASC 606, every time we talk about it, I learn something new. This time I'm sufficiently scared that now we know what's going to happen if we don't comply. And we look forward to our next in the series where Randy discusses more about the technical process of implementation. And thank you once again, everyone, for joining us, and we will talk to you later.